Buying shares of a stock and then profiting from the share price appreciation isn't the only way to make money in the stock market. What a lot of large, stable companies do is reward their shareholders just by owning shares of their stock. And this reward is called a dividend. A dividend is just a sum of money that is paid regularly to its shareholders out of the company's profits. And the reason companies do this is to make their company more attractive to investors and therefore make them more likely to buy and hold shares of their stock. Because for an investor, receiving regular dividend payments means steady income. And companies that can afford to pay their shareholders a dividend means financial strength. So if a company is in a position of financial strength, that could mean an appreciating stock price as well. So investing in dividend-paying stocks not only gives you a chance to create a stream of income, the market value of that asset can appreciate as well. Think of it as the same thing as if you were to buy a house to rent out to tenants, and then you receive a monthly income from the rent. Let's say that we bought this house in all cash for $100,000. It's fully paid off, and we get our first tenants in there, and they pay us $1,000 a month to live there. Well, that $1,000 coming from rent is going to be all profit. And we could take that money and then put it towards our personal needs. But as for the house value itself, it's still theoretically worth $100,000. And given the right circumstances, if the house is in the right neighborhood, it's in a good school district, and it's well taken care of, the house itself can appreciate in value over time, so that if we ever do want to sell the house, we could sell it for a profit. So not only did we collect all those monthly rent payments, the house value itself could appreciate as well. So it kind of works the same with stock and dividends. Now, just to be clear here, I'm going to be showing you some examples, and in no way are these going to be recommendations for purchasing these companies. I'm just going to be using these as an example here. And the first company we're going to be looking at here is Pepsi. And down here, you're going to see all the dividend information that Pepsi pays to its shareholders. So every year, the annual yield, Pepsi is going to pay 2.78% of whatever the shareholder owns just in dividends. Another way to look at this is on a per share basis. So the annual dividend rate, every share that the shareholder owns of Pepsi, they're going to receive $3.82 per share. Now, these are the annual rates. Most companies pay out a dividend every quarter. So if we take the annual yield and divide it by 4, well, each shareholder is going to receive around 95 cents per share every quarter. So that's money that you just get just by owning and holding shares of Pepsi. But on top of that, the value of the shares may appreciate as the stock price increases. So if you do this correctly, receiving dividends is a great way to add some extra income. And really, the ultimate goal for any investor would be to one day have an account large enough to live strictly off dividend payments. Because if you can pay for all your expenses just through the cash flow generated by dividends, you don't have to do anything. That is just straight up passive income, and you could potentially never have to touch your principal account balance. For example, if you threw $1 million into this Pepsi company stock, right? Well, Pepsi pays a 2.78% dividend every year. 2.78% off of $1 million is going to come out to $27,800. And that's just going to be in dividend payments, while the $1 million itself could appreciate in value as long as the company continues to do well and the price of the shares appreciate. All right, so when looking for quality, stable companies that pay a decent dividend, a good place to start would be the S&P 500 Dividend Aristocrat list. Dividend aristocrats are companies inside the S&P 500 that have increased their dividend payouts every year for more than 25 years consecutively. When a company is able to increase their dividend payout year after year over several economic cycles, you know that is a strong and stable company. So owning these types of stocks would be a safe way to generate income. Now, not all companies pay dividends, or at least not a very high amount of dividends. And there's a few reasons why a company chooses to pay or not pay dividends. Whenever a company makes a profit and is sitting on a surplus of cash, they have a few options on how to better use that money. Let's say that company XYZ here made a $10 billion profit for the year. After all the expenses are paid, they have $10 billion just sitting there. Well, option A would be to take that money and then reinvest it back into the company. Because if they are a small and young company, they can use that money to develop new products, fund certain projects, maybe build more factories or stores. Maybe they can buy out other companies to expand their income potential and possibly reduce their competition, or maybe they can just pay down debt, all of which will allow the company to grow and then therefore generate even more profits in the future. Option B would be to take that $10 billion surplus, or possibly just a percentage of it, and then distribute it amongst its shareholders, rewarding them for investing in their company. Now, the reason this may be a good option is because it sends a message to investors that the company is doing well and is likely to continue to do well, which will attract even more investors to own shares of that company. Now, whether a company chooses option A or B really depends on where the company is at in their business cycle, or what the directors of the company feel is best for the company. So using our XYZ company here as an example, when they are in the early stages becoming an established company, it would make sense to reinvest everything they earn so they can grow. Because in the early stages, the company has so many opportunities to capitalize on growth. They can buy more factories, expand to different countries, buy out competitors, and so on. And when they do this, their company can see a rapid pace of growth in a short amount of time. Now, if they are successful and able to grow into a very well-established company, there will be a point where the company just can't expand at a pace they once did in the early stages. The company can get so large and establish such a dominant presence that although they can still be very profitable, the company management can't really find any better growth opportunities within the company. They could have already bought out all their dominant competitors. They could have already paid all their debt and expanded all across the world. Basically, they've accomplished everything there is to accomplish inside their industry. And now they are in a phase of just sitting back and managing the company for steady profits. Now, sure, they will have some growth opportunity here and there, but it's just not going to be at a rapid pace like it was in the early stages. So that's when they have entered into the maturity phase. And once companies are in this phase, it's most likely that you will start to see them pay dividends to its shareholders and then start increasing those dividends every year, because that's a way to compensate investors to make up for the slower pace of company growth, but still be attractive for investors to buy shares. Now, I kind of want to compare the typical stock price behavior between a company in its growing phase to a company in its maturity phase. And what you would typically see is the stock price of companies focusing on growth, they're going to be more volatile than a stock price of a mature company. The reason why is because companies focusing on growth can have a lot of potential to generate a lot of profits quickly if the growth strategies go well. On the other hand, things can backfire. If a growing company comes up short on expectations, you can see a fall in stock price just as fast as they went up. So in a strong bull market, growth stocks have a lot of potential to outpace the returns of the overall market. But also, since these companies are in the growing phase, they can experience some turbulence, especially in a bear market. So these kinds of stocks can be less stable. Most mature companies are more stable because they've already established their place in the industry and have likely got to a point where they aren't going to see rapid growth. So these kinds of stocks are going to be a bit more stable. They can appreciate in value in a bull market, but when it comes to a bear market, they can be a little bit more stable. So a lot of times in a bull market, you'll see investors kind of switch to growth stocks. And then when we kind of go into a bear market, you'll see investors kind of shift over into the maturity stocks because they're going to be a little bit more stable in a bear market. So going back to Pepsi stock here, Pepsi is a large cap stock and is a well-established company distributing beverage products all over the world. But they are at a point where there isn't really much more opportunity for rapid growth inside the food and beverage space. They've already dominated that industry and now are one of the top leaders, which is why they pay a pretty decent dividend. Now, this is Pepsi's performance over the past 5 years, from January 2015 all the way to the date of this recording, which is about the end of 2019. So 5 years of price performance. And over those 5 years, the stock price has appreciated 45%. Now, 45% over a 5-year time span isn't an outstanding return, but it's a type of company that is going to be stable no matter what the overall market is doing, because people are always going to buy their products even in bad economic times. Now, I don't know if you know this, but Pepsi owns a lot of brands other than their most known soft drinks. They own Aquafina water, Gatorade, various chip products like Lay's and Doritos. They own some cereal products like Quaker and Captain Crunch, and people are always going to buy those things even in a tough economic time because people need to eat, right? So investing in a company like this would be a good idea if you were investing for income because it's stable and it pays an attractive dividend. Now let's look at another one here. This is Amazon. Amazon is another large cap stock, which is a very big and well-established company. And you may think that since they are so big, they have matured to a point where it really can't expand anymore. But Amazon does not pay a dividend. And the reason why is because Amazon's management feels that the profits they generate can be better used to reinvest back into the company. And if you've been keeping up with Amazon over the past couple years, you can see that they are trying to get into different industries. In 2017, they bought Whole Foods, the grocery chain, so they are trying to get into the food retail industry. Recently, they are trying to get into the pharmaceutical industry and also the mail carrier industry. So all these business strategies that Amazon is pursuing comes from Amazon's management trying to grow the company even more to generate even more profits. And investors like to see that, which is why Amazon's stock price over the past 5 years has gone up over 450%. So during those past 5 years, Amazon has experienced a lot of growth. Now, could this rate of growth last for many years to come? It could be, but there is a lot of factors at play. It depends on the economy and how their business strategies play out. But there will be a point where Amazon's growth will kind of start to slow down because it may have exhausted all those big opportunities it has to grow further. Now, we'll take a look at one more here just to show you that because a company pays a dividend does not mean it's done growing at a rapid pace, and the company's management isn't trying to use the profits to keep expanding. Microsoft is a great example of this. Microsoft is still considered a growth stock as they are always innovating and creating new products, and it's reflecting in their stock price gaining over 200% in the past 5 years. But they still pay a 1.46% annual dividend. So even though a company is a large, well-established company, it doesn't mean that it doesn't have more room for growth. And just because a company pays an attractive dividend doesn't mean it's not using those funds to expand on growth. So you have to remember, it's important to look at the company itself and what they are doing rather than focusing too much on the amount of dividends that it pays out. Now, dividends can be a great source of income, but in order for that income to be anything substantial, you have to have a large account balance because dividends from quality companies only range from about 1 to 4% per year, which is why the general rule of thumb in the finance world is to only withdraw up to 4% of your account balance for income on a yearly basis. Because if you can withdraw 4% or less from your account balance each year, then you could potentially never have to touch your initial principal balance, therefore making your money last a very long time and keep producing continual income. Now, of course, there's lots of other factors that play into this, which is why 4% is a general rule. Your specific situation, such as how long you want your money to last, your income needs, and your goals could make this a 3% rule or maybe a 5% rule. But we'll go with 4% here, and 4% isn't going to be a lot of income unless if you start getting into the six-figure account balance range. So if you have $100,000 in your account and you generate 4% of dividends from that, then you can generate $4,000 a year while theoretically maintaining the original $100,000 account balance. But if you're like most people, you're probably starting your stock market journey with a lot less than $100,000. Most people under the age of 30 don't have six figures in savings. So if you are young and you have a small account balance, focusing on dividends to provide income is probably not the best route you want to take because you aren't going to generate a lot. So for young, small investors, it's best to use a strategy that focuses on growth, similar to how companies who are focusing on growth expand. And that is reinvesting every profit you get into your account, because by reinvesting the profits, you will grow your account faster, and over time, those reinvestments will start to grow your account in a snowball-like fashion that will eventually lead to that big account that is going to generate a dividend income return that you can one day live off of. So most reputable investing platforms will have a program called a dividend reinvestment plan. And what this does is allow you to automatically reinvest the dividends you receive from your holdings by buying fractional shares. So here I've pulled up an example from when I invested into a company called NVIDIA. They are a growth style stock, which also pays a very small dividend. I think it was like 0.3% a year at the time, but I chose to reinvest the dividends I received back into this company. So on March 22nd, 2019, I received $2.57 just for owning shares of this stock. That's what I received in dividends for the quarter. But since I elected to reinvest my shares back into this company, my broker automatically took that $2.57 and bought $2.57 worth of shares. But seeing how the stock was $174.05 per share at the time, it's only going to buy a fraction of a share, which in this case is 0.0148 of one share. And my broker does this automatically for me, commission free. I don't have to do anything. Now, this doesn't seem like a lot of money, but you have to remember, dividends are earned as a percentage of the value of the position. So as the value of the position grows, so will the amount of the dividends. And we'll talk about the power of compounding returns in an upcoming lesson, but over many years of reinvesting the dividends, these small gains added together is really going to grow the account at an exponential pace to where one day the account is going to be big enough to maybe live strictly off the dividends. So if you are young, you want to try to reinvest as much as you can because it's going to really help grow your account much faster. And in the end, you're going to end up having a much larger account than if you were to take the dividends out and spend them on other things, which is fine if you want to do it that way, but you just need to be aware of the future implications. Your account isn't going to be as large down the road if you don't reinvest the dividends. And again, this all depends on your personal situation. What do you value? What are your goals? For me personally, I would like to one day leave legacy money to my kids if I ever have them, but I think that would be really awesome to leave them a $1 million account that generates $40,000 a year when I die. That money could really help them out. And if they choose to, they can add to that account and then pass that account on to their kids, and they can pass that account on to their kids, and so on. So basically, what my goal is to try to create a tool that generates wealth and then keeps that wealth in the family. But in order for me to do that, I have to reinvest everything to grow the account as much as possible. And then once I hit retirement age, I need to try to take out less than 4% a year from the account to pay for my retirement expenses. But the point I'm leading into here is that is my personal goal. That may not be your goal. You may never have kids, or maybe your kids are jerks and you don't want to leave them anything. That's fine. If that's the case and you don't want to leave any legacy money, then you could probably get away with not having to save as much. Or maybe you can take out a little more than 4% a year when you decide to use your investments as income. This is why it's really important to think about your future goals, because how you choose to invest your money now, whether it be dividend investing or growth investing, can have a dramatic impact later on down the road as to whether or not you will meet your future goals. Everyone is different when it comes to personal finances, which is why it is recommended to sit down with a certified financial advisor, and then together you can come up with a plan that will most likely achieve those goals. All right, so that is dividend investing. I hope you all learned something. Thank you so much for watching.